Good morning and welcome to this Monday, July 20th, 2020 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Looking at the market at the end of last week, we did see maybe a little bit of hesitation. We saw the Dow pull back a little bit, the S&P rose, NASDAQ rose a little bit. Saw a little strength in the mid caps. Small caps were down a fraction. But really for me last week, and we'll get in and look at the charts here in just a second. For me last week, it was really just about the rotation. I mean, clearly it was a different market last week. I mean, you might look at the charts and say not really much changed. But I think if you looked at, if you really studied what was going on under the surface of the market, there were changes that took place. Now, I think probably much of it is temporary. I think a lot of it is bullish, though. We're starting to see money rotating into areas, and we're beginning to see some absolute breakouts in some areas that had been lagging before. And I don't know if that's going to lead to outperformance in those areas, but at least it is showing that many of the areas that have been lagging are still healthy. And that's pretty important. I mean, absolute strength, relative strength, two completely different animals. But and we want to follow relative strength, but it's always good to see absolute strength, even in the weakest areas. We want to see, in a bull market, it's rising tide lifts all boats, and that's what is important. When you see too many areas weak and on sell signals, that's where the market really struggles to go higher. And I think with what's been going on, especially what happened last week, we're actually beginning to see some groups that had been maybe lagging temporarily, starting to show strength again, as in healthcare. And then other groups that have just been lagging, period, for quite a while, breaking out. And there I would give you the example of materials. Materials really been strong. We're going to talk a bunch about materials. But before I get into any of that, I do want to just kind of let everybody know that we have a big event coming up tonight. It is our Q2 earnings webinar. We do this quarterly. And I'm going to be looking ahead and seeing which companies I think look like they're poised to beat estimates, which ones look weak to me. That's not to say, trying to pick which company is going to report good results is different than trying to pick which company is going to react positively. Sometimes companies go up, and they've been going up so much, they come out with great numbers, raise guidance, and the stock sells off all day long. We have to be careful that we don't just assume that a earnings beat means higher prices, because that's not the way the stock market works. So I think this webinar is important because it gives you a list of stocks that I think have a really good chance of beating. And if they do pull back, they could create some great opportunities. If they do beat, and especially if they raise guidance and then the stock pulls back, you have to think about how the market works in the near term. It's very inefficient in the near term. Everybody wants to jump in. When everybody wants to jump in on that great news, some people look at a chart and they'll say, well, I don't understand why the stock's gone up 20% in the last month. And then the earnings come out, raise guidance, and they're like, oh, that's why, let me jump in. And you get a lot of that emotional trading at tops, short-term tops. Why? Because everybody wants in. The masses are going on one side of the trade, and guess who's on the other side? Market makers. Market makers are providing liquidity, they're shorting, and so temporarily it's in their best interest for a stock to move lower. Plus, once you get those last folks saying, hey, that's it, I'm in, where do the rest of the buyers come in? It's usually the emotional crew that come in at the top, and then the market pulls back, runs out of buyers, market makers get control of the action on the short side, and we come back down. Anyhow, this webinar later today is going to be great. So you can sign up. You can go through the portal here at EarningsBeats.com, click on this Join Today button. You can sign up. You can see our portfolios, even though last week was a little rough because of the rotation that I talked about. I'll be honest, I was expecting it. I mean, I think the 2 weeks prior, the model portfolio had gone up 7.5% each week and was crushing the S&P 500. I knew at some point we were going to get some profit taking, a little rotation, and it certainly happened last week. But you can click here and join. If you just want to join and become a member of our community, We have a free EarningsBeats Digest newsletter Monday, Wednesday, Friday. You just simply type your name, email address, subscribe, no credit card required for that service. And we'd be happy to have you join our community. All right, let's get into this because we do have a lot to talk about today. So last week, Friday, the Dow, you can see down 62 points, S&P, NASDAQ both up slightly. Mid caps, best performer on Friday, small caps, slight negative, but overall we continue in this uptrend above the 20, above the 50. That's important. All of our major indices are above their 20-day moving average. Their 20 days are above their 50-day moving averages. And the PPO, for the most part, is not stretched. Maybe the NASDAQ is a little bit, but you can see the Dow, S&P, mid cap, small cap, all coming off the center line and just starting to turn back higher. We could still see the market going higher. And by the way, this is one of the worst weeks of the year historically. July 17th to July 24th. Of course, today's the 20th. This is the second worst week of the year, going back over the last 70 years of the S&P 500. The only week it trails is, you may have already guessed it, October 21st to October 27th. That's the worst week of the year. July 17th to the 24th, historically, is the second worst. Both periods, if you kind of look at it, is right after earnings season starts. So all of this buildup going into earnings, a lot of folks jumping in thinking, oh, earnings are going to be great. And then the actual earnings come out and they are good. But what happens? Buy on rumor, sell on news. So you got to be careful this week. I think this is going to be kind of a, I don't know, you're going to want to kind of be tiptoeing through the market, I think, just because of the historical precedents that's been set, and then the rotation. Predicting this market to go higher is only half the battle. Predicting which part of the market leads it is the bigger battle. And for the most part, it's been those strong pandemic stocks that have been leading the market. But this last week, that was not the case. There you can see at the bottom the sectors that were leading on Friday. For the most part, many of these sectors led last week. You got utilities leading, real estate right there, healthcare. This was big, nice breakout after consolidation. Notice the last pullback in the at the end of the first week, beginning of the second week of July. Notice where we bounced off of the 20-day. So you can kind of see in the past, during this consolidation, we've lost the 20, we regained the 20, lost the 20, regained the 20. Well, this last time, when you get a test and you hold and then you break out, that to me is a signal. And the signal, unless it gets changed, is we're going higher. So I would be watching this healthcare group. I'm going to talk a little bit more about healthcare in a bit. That group looks really good to me. Materials breaking out. This is the talk of the town right now, materials. Is it a big breakout? Is this going to be relative strength in materials that we want to be part of as we go forward? I'm not quite sure just yet. I think that a lot of people are jumping the gun. We've seen this game played out before. I'll talk about it in a little bit. And then you got industrials bouncing back. Still, among the aggressive groups, financials and industrials have been the laggard. But even though they've been the laggard, even though they've been weak, even though I've been criticizing them, even though I've been staying away from them, industrials are above the 20-day and the 20 days above the 50-day. So this is a bull market. The weakest look good. That's a bull market. That's not a bear market. Anybody thinking this is a bear market, or that, because of COVID, we're going to go back down to the 2,200 level on the S&P 500. I don't see it. I think the technicals now have come back. I mean, before I wasn't believing it back in March and April because of the way part of the market was acting, the way stocks were being accumulated. Even though we were getting these huge, massive gap downs, stocks were being accumulated during the day. All of those things were pointing to me that, hey, this is not what institutions do in a bear market. They sell during the day. You don't just open down. To me, it was hype, the media, negative hype that was wearing on everyone's emotions. Everybody was every morning just wanted to sell, because you wake up, Dow futures down 1,000, down 1,500. You just can't take it anymore. But the selling was always at the open. On a net basis, we were not selling off during the day, even in the midst of that pandemic. That was the first sign that this was not a bear market. And now we've got all the technical, signs to go along with it. So anyhow, I could talk about that. I can make a whole day's webinar out of that. Let's keep moving. 10-year Treasury yield. Let's get a quick update, see where we are here. This is good news, bad news. 10-year Treasury yield down today, another 2 basis points back to 0.60. So why is it good news? Because I've always talked about 10-year Treasury yield going higher, and that's good for the market. I think from a S&P 500 big picture standpoint, yes, we want the 10-year Treasury yield going higher. We do not want this going lower. And since we've been going lower back in after the first week of June, the S&P has been underperforming. I mean, really since June 8th, the money has rotated into, I mean, our model portfolio since that time has gone crazy. Our strong AD portfolio, our strong accumulation distribution portfolio, gone crazy. Our aggressive portfolio has gone crazy. Why? We were in a lot of those stocks being accumulated back in March and April, many of the high growth areas. That's what our portfolios have had in them, because I believe any companies beating their earnings estimates and raising guidance in a low interest rate environment, historically low interest rate environment, their valuation should go through the roof. And that's what we've been seeing. So the fact that rates stay low, I think remains a good thing for those companies that can grow earnings in this environment. The bad part about this is that the 10-year Treasury yield moving lower, I think if you start talking about economically sensitive areas of the market, transports and things, it's going to be hard for those areas to sustain moves to the upside when everyone still continues to pile into the bond market. You don't pile into the bond market if you think the economy is going to be gangbusters going forward. So this is always a warning sign. You know, I always like to watch the bond market even when I'm looking at the stock market, I want to look at the bond market because I want to know what bond traders are saying, not just what stock traders are saying. And you know, how many retail traders do you know that trade bonds? I mean, I know a lot of people that trade the market. I've never had anybody come up to me and say, wow, did you see that move on the 10-year Treasury? People don't trade bonds. Rarely. I mean, you've got professionals that are obviously allocating money into the bond market and so forth. The bond market, I always say, is the more professional market. The stock market, not so much. And I trade the stock market, but I try to take advantage in the short term of what's taking place. And one of those signals is the bond market. Anyhow, if we could get this break and start trending higher, I think that's great for the overall market. But I think what you will see is money rotating away from the things that have been leading. Many of the stocks in our portfolios, I don't think they would do well, at least initially, if rates start to move back up again, because I think that's going to signal to the stock market that, hey, economically sensitive stocks should do well. Money is going to rotate into transports, financials, industrials, and less money is going to be available. It's not that people still won't buy tech stocks, but it's just less money. Rotation, 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 rotation. All right. So I mentioned earlier, and I want to talk about materials. So here's the materials chart. And actually, before I even do this, let me go back over here. Let's go in and take a look at the sectors. So when you look at the sectors and you rank them by scooters, look at what's on top. Technology, that doesn't surprise anybody. Look what's second. Materials. Where did materials come from? You know, materials now above consumer discretionary, healthcare, and communication services. That's pretty impressive. But if you listen to me and you've heard me talk about the scooters, there's one real limitation with the scooters. The scooters only look back. If you're looking at a scooter score, don't look at the scooter score and say, oh, materials are a great long-term trade. Scooters, by their formula, only go back about 5 or 6 months. So if you're doing well on a relative basis for the last, 4 to 6 months, you're going to probably have a pretty good scooter score. But if you've got a long-term downtrend track record and a short-term positive scooter, that can be the time to sell. So which materials group are we looking at? Are we looking at a materials group that's going to be a leader going forward? Or are we looking at a materials group that's doing another head fake? And believe me, there have been plenty of head fakes. All right, well, let's take a look. First thing I want to show is the absolute breakout. And if we look at a weekly chart, I mean, I think clearly we can get excited about this. I mean, we had a top in January 2018, same thing in December, January, February, you know, the 60, 61 area, can't get through. And then all of a sudden last week, we're up 5.5% in materials and we close over 61. And, you know, I've seen a lot of analysts talking about materials. This is the group. Let me tell you why I'm still a little nervous about materials. Trust me, I recognize what's going on, and there are some areas within materials that are starting to show good relative strength, and that's always something I keep an eye on. But the one thing you have to understand about materials is, and we're going to look at this on a relative strength basis, and not just 5 years, but let's go back 20 years. And how about let's bring up the dollar and see what the dollar's been doing during this period, because these are all things I think are really important in trying to determine what's going to happen with materials. So let's hold on a second. Didn't set that up very well. Take a look at this. Okay. So if you look at materials relative to the S&P 500, that's important to me. I want to know what's going on a relative basis. All right. We had a double top back right around as we went from the, you know, change the decades here, 2010, 2011, we topped. Now, if you look at this, we've been downtrending in materials versus the S&P 500 for 9 years. What's the common denominator? The dollar back in 2011 bottomed, and the dollar has been in an uptrend for 9 years. Now, if we pull up this trend line right here, you will see that we are still in an uptrend. I don't care how you slice it. We've had weak periods. See these weak periods? And guess what? We've had strength in materials during those weak periods. See how we went down in 2017? Materials outperformed for a while. But what happened when we hit the trend line and turned back up on the dollar? Materials underperformed again. Now, what's happening the last few months? And why is the scooter going up? Well, the dollar, which by the way, went up, set a double top. That might be a top, we don't know yet. After setting that, we've been pulling back. The dollar's fallen from 104 down to 96, the dollar index. So what has materials done during that time? It's gone back up again, getting everybody excited. Has the dollar broken down? No. Yes, in the short term, it's weak. Has this trend, it's a long-term trend line that's been trending higher for a long time. Has this gone down? You know, have we broken down? I don't think we have. I would be concerned if the dollar were to break below 94 and hold that, sustain that move below 94 and start heading toward the low 90s. I think that would be a signal that we got something going on here. But how do you figure out what the dollar is going to do? I mean, there's got to be something that we can look at to say, what, you know, is it a good chance that the dollar is going to break down, or is it a better chance that the dollar is going to hold? And for that, what I would look at is this chart, which I've shown before. This is a chart showing the 10-year Treasury yield versus Germany's 10-year Treasury yield. So it's how our yields are doing relative to Germany. Why is that important? Well, we're a global economy. I mean, we can't just look at what's going on in the US. I remember when I was in Economics 101 back in the 1980s, it was like, okay, what's the US doing? What are rates doing here? That's going to impact the dollar. Well, we're much more of a global market now than we were 40 years ago. So when I look at this, I want to know not just what the US economy is doing, but how is the US economy faring versus other economies? And I always pull up Germany because I think the correlation between the US and Germany are pretty tight. So, and that's, you know, born from charts and facts. It's not just my opinion. And so I like to see what's going on. When the yields are going up faster here in the US than Germany, that's telling us that bonds are being sold off here faster, which tells me that our economy is stronger, right? I mean, if our yields are going up faster than Germany's, then our economy is probably stronger than theirs. When it goes the other way, that means Germany, at least the market is anticipating Germany to be stronger. Now look at this chart. This is the difference between our two yields on the top. So you can see US was going up for quite a while. Here's the dollar, US dollar index, and you can see the dollar kind of going lockstep with the difference in yields. And then down here's our correlation, which tells us, the difference between our yields versus the dollar. Is there a positive correlation? I would say yes. For the most part, we're in positive territory. So I think this is a good signal for what's going to happen with the dollar. Now, these green shaded areas that I show are areas where we had negative correlation, inverse correlation. See these circles where we go into the negative territory? Well, if you look at the action on the chart here, this was back in 2009, US yields were going up faster than Germany. That should mean the dollar goes up, right? Dollar went down. What the heck's going on? Oh, here comes the dollar. We had a little catch up. So what happened back in 2013, 2014? Yields going up. Oh, dollar went down. Wait, here it comes. There's your catch up. Let's move to 2017, 2018. Yields going up in the US versus Germany. Dollar should be going up, right? Nope, dollar was going down. Hit that trend line, and then we had this big reversal. The difference now, and I think this is what is getting some folks excited, is, and I've said on my shows, when I saw the 10-year Treasury yield going down versus US versus Germany, and the dollar going up, that's a warning sign. The dollar could get hit. And there's your inverse correlation showing up. So the dollar is getting hit. But the question is, now we are consolidating right here. I think we're kind of at a crossroads. Is this Treasury yield, is the US Treasury yield going to start to move back up against the German Treasury yield? And if so, look for this trend line to hold and materials to underperform. If this breaks back down to the downside again, and the dollar continues its decline and breaks that trend line, I think you've got a much stronger play with materials. So all of this ties together, and all of this intermarket relationship stuff is so important. It's not just looking at materials and saying, oh, they're breaking out. Let me go, overweight in materials. There's a lot of things you have to look at. I just wanted to point all of that out. Now, if we look at some of the areas, talk about materials, and you can see, this is just on Friday. You can see materials right here. Gold, the miners, gold mining did very well. Paper did very well. I'm just looking down here at the XLBs. Here you got the commodities doing pretty well there. But this is just Friday. So why don't we look at the last week? Now, if we pull up the last week, look what's on top. Aluminum. Paper is in the 6th spot. Here's the commodities. What's that? The 11th spot. I mean, you can see last week money was definitely rotating into materials. What else was it rotating in? Railroads, transports. What? Now, I've said airlines are holding back transports. Transports aren't doing nearly as badly as they might appear. And that's with the Treasury yields going lower. Imagine if we start getting money rotating out of the Treasuries. I think money would pour into some of these transports. So railroads are already in it, and maybe this is what's going on. Maybe you got some professionals that are already starting to anticipate that and moving into areas like the railroads. Medical supplies. Healthcare did really well last week. Medical supplies is a big part of that. And then you've got financials, industrials. Look at the makeup of the top 5, 6. You've got materials, industrials, financials, healthcare, industrials, materials. See what I mean by rotation? This would not have been the leaderboard in the weeks prior to last week. I can promise you that. So whether or not this continues, hard to say. I think part of it is going to be that intermarket analysis. What's the dollar do? Because if the dollar breaks down, not only will materials do well, but we'll start seeing energy rebounding. Energy's been the worst sector by far in 2020. All right, what else we got? How about let's jumping into some of the earnings. And in the earnings, Halliburton reported this morning, speaking of energy. And we look at this chart, and I mean, I don't see anything overly exciting. I mean, we were up in June, kind of pulled back. However, we're in a bull market. I think on an absolute basis, I expect Halliburton to go higher. I expect just about everything to go higher. Airlines, cruise lines make me nervous. I'm not sure because I just don't know what the longer term impact is going to be for those businesses. We still got some airlines going to be reporting earnings soon, cruise lines as well. What the heck are they going to say? I mean, they've had no customers, very few. Maybe airlines a little bit more, and cruise lines, you know, just a disaster with the pandemic. So I don't know what they're going to say. And honestly, I don't want to take those chances. I mean, it's just, that's way too much risk. I'd rather go with what's working. But I do think stocks like the energy stocks, which have been beaten down, they are back in an uptrend. They're just way off their earlier highs in 2020. So on a relative basis, yes, they continue to lag badly. And you can see that down below. I mean, here, look at the peer group and relative to the S&P. I mean, we're down near 52-week lows. Halliburton has been one of the best stocks, though, within its space. And they just came out, they missed on their top line, but they beat on their bottom line. They came in and had a profit, 5 cents. Market was expecting a loss of 11 cents. So when I looked last, the stock was up 6.5% pre-market. So 6.5%, we're talking probably about 80 cents. 13, I mean, we're going to be up close to this 14 level. See if we can get through. That's going to be a big short-term area, right where that black candle, right at gap resistance. This area between 14 and say 14 and a half, I think it's pretty good resistance on Halliburton. If we break through, I think we're going to run back toward that June high. And what we might see is an uptrend in a cup. That is an uptrend followed by a continuation pattern. So if we can get through 14, 14 and a half, I think Halliburton goes back over 16. Other earnings, Lennox International, LII, they had a really solid report. Beat on the top line, 941 million versus 906. Beat on the bottom line, 297 versus 262. They guided their fiscal year 20 revenues and earnings per share higher. By the way, we now have a new chart list that we're going to be sending out to members later today. It's a raised guidance chart list. Had members, when I've talked about earnings and strong earnings, they're like, well, do you consider companies that are raising guidance? And up until today, we hadn't. But we do have a new raised guidance chart list. We're going to talk about that a little bit during our Q2 earnings webinar tonight and unveil it and go through some of the stocks. But this company, Lennox, will be on it after this because they guided their fiscal year 20 revenues and earnings per share higher. Stock looks pretty good. I mean, accumulation distribution off this bottom starting to strengthen. We've got the stock moving higher. You've got the group not breaking out yet, but the group's been in an uptrend. And I think after today, we'll see, but we might get a relative breakout on Lennox. It's been performing well versus the S&P, and its group's been performing well. So, you know, and this is one of those areas of the market where if we do see rotation continue into more economically sensitive areas, stock like Lennox would perform well. So, but anyway, good earnings report, raised guidance. Stock was up 4.5% in pre-market. So 4% would be roughly 10 bucks. So I'm guessing we're probably somewhere up in the upper 250s now. So got to get through 260 and maybe even 262, 263, but we're getting closer and closer to a big breakout there. All right, later today, after the market closes, IBM, Cadence Design, one of our portfolio stocks, will be reporting. Logitech, let's see, LLNW, this one's going to be an interesting, it's a small company. Just pull this one up and then I'll go into the three you must see. But here you can see the stock broke out, nice volume. It's in the internet space. It's been one of the leaders. Are they going to report blowout numbers? I mean, looks like a lot of volume. Stock's been going up, holding, you know, broke out above 7, came down, tested the 20 and $7. Are we going to get that big gap up? This is going to be an interesting report after the bell for sure. All right, let's move into the three you must see. These are three companies that come off of our raised guidance chart list, by the way. So let's first pull up Chewy, CHWY. Actually, let's pull this up on a relative basis. I like the stock. After it came out, raised guidance, the stock went up to that 52.5 area, but has been sideways consolidating. I think anything down around this 45, 46 area looks pretty good. Stock was just up to 52.5. I mean, I think we got 10% or more upside and just a couple percent, 3%, something like that downside. As it moves its way down toward 45, I actually like accumulating the stock. It's in a great area, specialty retailers. Look at the group. So you got a strong stock and a strong group that's been consolidating. This is one definitely could make a run. HIMX, This is Hymax Technologies. So this is a semiconductor. Look at the big move here with its raised guidance. Pulls back, nice test on the 20-day. I think the 20-day down to the top of gap support around 350. Very interesting for entry. I wouldn't be surprised to see the stock running back up toward that 440 level. Even from where it is now, that's probably about 40% or 14%. 14% potential to the upside. And as you move down, that upside grows and your risk starts to fall a little bit. All right, and then the last stock is AXNX. A lot of sideways consolidation here. Medical supplies, just talked about medical supplies, how that group is really starting to strengthen. Look at the relative strength, ready to make a breakout, getting close to it. And here you got a stock consolidating sideways. If we get a breakout in medical supplies, you want to watch AXNX. Break above 42 would be very bullish there. All right, market is open. Show is over. Let's see what the market is doing here. Well, NASDAQ leading on a relative basis to open. The Dow down 16, S&P relatively flat, up a couple points. But just keep in mind, if you do see the market go down, historically, that's about what we do. I mean, the market tends to go down a little bit. Now, just because it's the second worst week of the year doesn't mean that we have a crash from the July 17th to July 24th every year. Not trying to paint that picture. What I'm saying is that the tendency, historical tendency is for the market to move lower this period. We have had plenty of July 17th to July 24th periods where we've gone higher. I haven't looked at the numbers in a while, but I would say maybe 40% of the years it goes higher, maybe 60% of the years it goes lower. But when it does go lower, the tendency is for it to go down a little bit more than normal. So, we've made a big run in the market. I wouldn't be surprised if we pulled back. The S&P trying to get through a key level at about 32. I think the level is 32.31 on a closing basis. And we're right up against it as we go into this bearish historical period. So keep all that in mind. It's going to be an interesting week. A lot of earnings coming up this week. We got Amazon looking ahead and some other biggies. So strap on your crash helmets and hopefully sign up if you're not already a member at EarningsBeats and join me tonight at 4:30 for our webinar. We'd love to have you. And again, if you go to EarningsBeats, you can sign up with that button, or you can just sign up for our EarningsBeats Digest, a free newsletter coming out 3 times a week. All you need there is your name, email address, and hit the subscribe. Everybody have a great day. Be back tomorrow over at Stock Charts TV for the next episode of Trading Places Live. Have a great day, everybody.